Okay, let's start here now. So the last session, you did not have a class, but as I instructed you, you should have watched the video from the last, from your group 1, the Tuesday class recording. So that recording finished in the middle of this slide. We were in corporation tax. So that recording finished in the middle of slide 77. So what I had talked about is these two profit rates, 1925. You don't have to memorize them. They are in the tax tables, and these numbers are also in the tax tables, the UL and LL. What you really need to understand is you need to remember the formula, which we will look at, the marginal relief formula, right? So if you remember when we were doing capital gains, we looked at something called principal private residence relief, PPR relief, where we have to calculate the actual and deemed occupation as a numerator, and then the period of ownership as a denominator, and then we take that ratio and we apply it to the gain, and that gives you the amount of relief you can get, the PPR relief. So if you sell a house in which you stayed, and then eventually after many years you sell it, you get some kind of capital gain, you get a gross capital gain, and then on that you can get a certain amount of relief before you get charged to tax, and that's your PPR relief. So your gross gain minus the PPR relief. So this one is also similar to this. This is also your tax liability will be calculated by looking at a marginal relief. Okay, so the marginal relief formula is what you need to remember. Okay, so I mentioned all these things in the last lecture, the upper limit and the lower limit, and this part is very important, that these numbers, these are for 1 year for only one company. It's 1 year for one company. So if it's actually a 4-month cap that you're calculating, a 4-month cap, chargeable accounting period is a cap. If it's 4 months, then you have to divide it by 4, these two numbers, 250, 50. You have to divide by 4. Then, if it's for 4 months, but if it's for 3 companies, if you have let's say 3 associated companies, which means the total number is 3 plus 1, right? We have to divide by the total number of companies in the group, 3 plus 1, but not active, which are active companies, not dormant companies. And so if you have, let's say this is for like 4 months, and it is for total of 4 companies, 3 associated companies plus the parent company, all are active. Then first you have to divide this by 4, not by 4, but basically 4 by 12. Fraction is 4 by 12 to get the number. You'll see the examples. I'm just giving you the theory. And then further you have to divide by 4. Okay, because further you have to divide it by 4 to get the number applicable for the parent company. Because you're only going to be calculating the profit and loss, the tax liability for the parent company. You're not going to be doing it for the associated companies, right? Okay, so we'll see how it goes, all right? So this is the main thing that we have to remember. All this stuff, augmented profits, the definition of that you need to remember. Augmented profits is taxable total profits plus exempt dividends, okay? Which is, basically all dividends are exempt, but you have to ignore the intra-group dividends. Okay, so let's look at what actually happens. So basically you get these 2 rates, and you have these 2 upper limit, lower limit. So if you're below the lower limit, then you are charged at 19%. If you're above a higher limit, upper limit, you're charged at 25%. And if you fall in between, your augmented profits is in between the 2 limits, 50 and 250. Then you will get charged at 25, but you will get some marginal relief. Okay, that's the one I was talking about, where you had principal private residence relief, similar kind of concept. Like, let's go here. Okay, now associated companies, here you have to look at control. Okay, this one, what is not mentioned clearly on the slide is or. These are all or. Any of the conditions can be satisfied. Okay, that's good enough. Okay, unlike if you remember in your capital gains, you had BADR relief, which is basically all the conditions needed to be satisfied for a personal company, like more than 50% share, more than 50% voting right. Here, this is a more important concept actually. It's more important than BADR. The reason I'm connecting it to BADR and to PPR is because if you always try to connect similar ideas that you've studied before, then it helps you to recall both of the ideas. So whenever there is a similar idea, you should try to connect it in your mind. And then you'll find that in the future you can recall both of them much better, much easier, much easier way. Okay, so control, you have to look at, like they will say that company A controls 4 other companies. So what is meant by control? So what we are looking for is kind of indicia of control, indicators of control. So it could be any of these, this or this or this or this, okay? So any kind of control, as long as you get the idea from the question paper that this company controls other companies and those other companies are active, yeah, then you can sit here on the first bench also if you don't have a place to sit, okay? All right, so as long as you have control, those are associated companies, and those are associated companies. Then if you have like X associated companies, then you have to divide by X plus 1. So we'll see what happens actually, how to calculate the marginal relief. This case is very important because most likely you will have. So here there's an example of Melville example 2. Let me go to, yeah, okay. This one now, we've already gone on to VAT actually, so I need to see where corporation tax is. I think we are now in the calculation part, which is 25, I think. Tax losses, yeah, computation. So let's go to marginal relief. Let's go to 389. So 39, so 406, maybe. 406, maybe. Okay, there's already example 4. So let me just yeah, so the example 2 really does not deal with the marginal relief. This is the same information that you see in the slides. So as I mentioned all the time, the always study from the with the textbook next to you, so that you refer to the textbook, look at the slides to see what is important. But the actual material you should see from the slides, from the textbook, because the slides are not up, you can't really put everything into the slide. So this has more information. Right, any associated companies, okay, so so all the rules are given here, okay. Now, you have to apportion the profit between the 2 years. Is quite logical. This example is showing you that. So let's do this example 2. Here you don't get to see the marginal relief because we haven't come to that stage yet, but that was just a precursor slide. I mean, a kind of a, yeah, okay, look at the example. Calculate the liability, each of the for accounting period concerned. Okay, so the year to 31st March. So watch out for all this in the language as well. Okay, sometimes they will say like 9 months to here, like this one, 6 months. So please read carefully. A lot of the time the students don't read the question carefully. In a tax paper, you have to read the question very carefully. Every word has to be scrutinized. So 6 months to, or year to 31st March. It's a one year thing. So first thing you know, as soon as you see 1 year, that means that you don't have to scale down the upper and lower limits. Okay. Here we are, you don't have to scale them down because it's already for a full year. And there's no mention of any kind of associated companies. So both the reasons, both the factors that you use to scale down, they're not relevant here. All right, so number 1, okay, so 800,000 and dividends is 70. So that means your augmented profits is 870. Okay, so augmented profits definition, that's not in the tax tables. So you need to remember that. Okay, augmented tables definition, your augmented profits definition, AP. Right, so what do we do here? This is dovetailing perfectly with the FY24, right? So this 31st March is ending on 31st March, so we don't have any real adjustments to do. We just find out what is the augmented profit is 870,000, and this is more than the 250,000. So the rate of tax in this case will be 25%. Okay, very simple. Number two, now it is for 6 months. So now you got to scale out. Okay, so also remember this part here, the thing that is given, that we use the augmented profits only to find out the rate of tax that is going to be charged. But when you find out once you finalize the rate of tax, you don't apply it to the AP, you apply it to the TTP. So you have to be careful about that as well, okay? Right, let's look at this here. So you can see that example here. They find out that the rate of tax is 25%, then the tax liability is 25 into 800. It's not 25 into 870, right? Okay, now let's look at this one. This one, what is this one? 6 months to 31st October. 6 months to October means it started from end of April. 6 months to 10, 4. So, so it's totally within the FY24. Yeah, so it's totally within FY24. That's what they're saying, right? So you can see that now, but it's because of it's 6 months, we have to scale down the upper and lower limit. You notice that it goes from 250 and 50, it goes down to 125 and 25, because you're doing the 250 into the 125 is basically 250 into 6 by 12. So they haven't shown the calculation here, but the 125 comes because you're doing 250 into 6 by 12, because it's for 6 months. If it was for 4 months, you would do 250 into 4 by 12, and so on and so forth, all right? So 25 is because it's 50,000 into 6 by 12. And what is the augmented profit? There are no dividends, okay? So that means if there are no dividends, that means TTP is equal to augmented profits. 0 dividends, okay? So what is the final number is 20,000. And what is the relevant number here? So remember that when we are reducing these upper and lower limits, we are trying to get it down to the comparison, we are trying to arrive at the proper benchmark for this particular example, right? So what is the example here? This is a company which has 20,000 of profits for 6 months, okay? So the appropriate benchmark of the upper and lower limit is not 250 and 50, it's actually that multiplied by 6 by 12, so that becomes 125 by 25, right? And once we get those appropriate benchmarks for that particular example, 125 by 25, then we compare the actual profit data for that example, for that period. This 20,000 is going to be compared to 25,000, right? It's not going to be compared to 50,000, because the appropriate benchmark for this example is 25,000. That's why you need to adjust the upper and lower limit numbers. Right, so you come to that, so you should compare 20 to 25,000. 20 is below the lower limit, so that means you will be taxed at 19%. So your tax liability is 19 into 20,000. 19% into 20,000. Is this clear? All right, number 3. Let's look at number 3. Now this is slightly more complicated. Now, 1.6 million for the year to December 23. Now, year to December 23 is not falling neatly into your tax year. Please don't forget your tax year, okay? Your tax year is running from 1st of April to 31st March. So this one is not falling neatly into the tax year. So now you look at the calculation here. I don't want to make it lower than that at this point. So you see 1.6 for the tax for the year to December 31st. Now you need to see it here, okay? Right. See here what happens. Maybe I should raise it a little bit more so that everybody can see it, yeah? So look at this one here, okay? So first 3 months fall into FY22, because the question is year to December 23. So year to December 23 is first 3 months are falling into FY22. That is the first 3 months of 23. And then the balance 9 months are falling into FY23. So here you see here, okay, so this you are not expected to know this, that the rate changed only in FY23. although it's given in the slide, but you're not going to be tested on this. So first 3 months fall into FY22. So let's do the applicable upper and lower limits for the first 3 months. So the first 3 months will be, so they haven't done that basically, 3 by 12. So you see what they're doing. The total number is 1.6. So 3 by 12 into 1.6, that's a TTP actually. This is the taxable total. There are no dividends in this case. And the upper limit, so here they have not bothered to do it because in the case of, here we know that the information is given that the changes to the second income tax, the 2 income tax rates happen only in 23. So in FY22 there was only 1 income tax rate. That's why the first part of the example they haven't done it. But what you could have done is you could have taken 3 by 12 into 250 and 3 by 12 into 50 and generated the upper and lower limits for this one, right? And then compared that number to compared the prorated profit for that period. Okay, so you could have compared the profit for that period into this thing, but they have not bothered to do that here. Now you see the 9 months falling into this is, so the relevant upper and lower limit is this. Okay, and augmented profits again also have to be calculated on a prorated basis because your augmented profits are the same as the TTP because there are no dividends here. So augmented profits is also, look at this prorating is not done in this case. Here you would have done like 3 by 12 over here, but they haven't worked that part of the example. So it's 9 by 12 here because 9 months falling into this, 9 by 12 into this, which is this, right? So that's your 1.2 augmented profits. Now you compare it to 187,500. So this is more than 187,500. So the rate will be 25%. Okay. This is the the benchmark for the upper limit for this example, for this part of the example. And your the prorated AP figure is 1.2 million. So it's more than this, and therefore you have to pay 25%. So total tax is 9 by 12 into this into 25 plus this one into 19. So that's your tax. So this is a very primitive example. We don't really use that. This is the one you need to remember. So this number is given to you in the tax tables, right? This and this upper limit is given to you. Augmented profit definition you need to remember, and you need to remember this formula. So you need to memorize this formula. It's quite simple. If you practice it a few times, the image will stick in your mind. So fraction times upper limit minus augmented profits times TTP. N is just the non-augmented profit, so you can also write it as TTP by AP, right? This is your UL minus AP times TTP by AP. Now this is your marginal relief calculation, all right? Formula for marginal relief. Here, this basically the left-hand side of this equation is marginal relief equals this. So when you get the marginal relief, you'll see how it's used. Okay, let's look at this example 3. Now it will also look at example 3. Now MR calculation. Now this one you've already seen. So we looked at, we just saw the textbook. I think the textbook picture is more clear in terms of the structure of the formula, right? So basically, if your augmented profit falls between the two bands, then you will be charged at 25%, but you will get some marginal relief. How much marginal relief? That's the formula. So let's look at this, example 3 in Melville. Okay, so let's look at the example 3. All right, let's look at this. Again, these are, first few are very simple. So 3 companies a year to 31st March. So no adjustment necessary because of time period. Okay, taxable TTP 525, no dividends. No dividends means that AP is equal to TTP. So full year, so the relevant benchmark is upper limit is 250K, but this one is above the 250K. So therefore the tax liability will be 520, it will be taxed at 25%. So 525 into 25%. Is this clear? That's your tax liability. Number 2, also fairly simple. 30,000, no dividends. No dividends means augmented profits is equal to TDP is equal to 30,000. No adjustment required because it's a full year. The relevant benchmark therefore for upper and lower limit is 50K and 250K, and the figure of 30K is below the lower limit. So therefore you get charged at the 19% small profits rate. That's your tax liability, 30K, not augmented profits, but actually the TDP into the tax rate. Is this clear? Yeah. Now the third one is more complicated because they have the TDP is, okay, I can't show you this whole thing together, but let's look at the information. TDP is 42 and dividend is 28. Okay, so let's work with this example. Yeah, now let's see the example here. Number C, okay, 42 and 28. So that's your TDP and that's your dividends. So put those together, you get 70,000 augmented profits. 70,000 augmented profits. Now, the period is 1 full year, so no adjustment for time period. But are there any subsidiaries? Are there any associated companies? No. So no adjustment of the ULLL required. So let's look at this one here. Yeah, so we got a figure of 70,000. Now 70,000 augmented profit lies between the 50,000 and the 250,000. So it's lying between the two limits. So now this will have a marginal relief element. So your first step is to tax it at 25%, tax the TDP at 25%, but then you have to give some marginal relief, right? So these are the two terms. So when you calculate the corporation tax liabilities, there are two terms. First you get the tax on the TDP at 25%, then minus the second term is the marginal relief, right? Look at the marginal relief. Here, this is the part that you need to master by memorizing the formula, practicing a few examples, because very likely you're getting a tax CT tax example. You'll definitely have a question on corporation tax, and so the so you'll get a question and they'll definitely ask you to do the marginal relief, most likely, because this is the more difficult part. So what do we do for the marginal relief? So marginal relief is MR fraction given in the tax tables, upper limit given in the tax tables, minus augmented profits. Definition you need to remember. Augmented profits is 70K here, times TTP by AP. TTP by AP. All right, that's your marginal relief. First term of the corporation tax liability is TTP times 25%, which is here. The second term will be minus marginal relief, and marginal relief is the whole marginal relief amount is this. If you do all this, you get this number, 1620. So the net tax liability is 10.5 minus the 1.6, which is your 8.9. Is this clear? Right? So this part you need to master, make sure you understand the calculation, and then you can practice a few times with some examples. There will be some other examples. Okay, now let's look at another one. Okay, the example 4. We are supposed to do example 4. Yeah. So again, we'll look at it from this one again. So TTP 100, year to 30th June. Year to 30th June, one thing good is that it's a full year, but there's a problem because the full year is not fitting nicely into a tax year, which is basically your 1st April to 31st March. So it's not fitting into the tax year. So now you have to split it. You have to apportion the profit into appropriate tax years. So you got to work with neat tax years. So how do we do this? You see here 30th June 24. June 24 means out of FY24, it is April, May, June. Only 3 months are falling into FY24. And the balance is falling into FY23. So let's look at the FY23 calculation first. TTP for FY23, you see that it has to be scaled down. The full TTP is 100K, but if you do 100 into 9 by 12, the TTP for this year is 75. Okay, you got the TTP. AP, what is the dividends? Oh, you got 20K of dividends. Okay, but you got to take, so your augmented profits for the full year is 120K, but you got to take for 9 by 12 of that, which is 90K. So your TTP and AP are calculated. Lower and upper limits have to be adjusted because you are considering a shorter period. Within FY23, you're only considering the last 9 months. So you have to take 9 by 12 into the LL and UL, and you get these two numbers. Is this clear? Is it clear of how to calculate, now you're apportioning the profit also. So in this example, you're seeing a slightly more complicated example where you're seeing the profit being scaled down, which you have already seen before, by the shorter accounting period. But you are also by the shorter cap, okay, to make it fit neatly into the tax years. But you're also seeing a case of the what else was I going to highlight here? So you're seeing the adjustment of the upper and lower limits, but you're also seeing the apportionment of the full year profit numbers into the neat little buckets of the official tax years. Okay, so this part is very important. You have to do that. So you do this now. FY23, let's look at the tax for FY23. What is the AP number for FY23? 90,000. What is the upper and lower limit? They are 90,000 AP actually falls between the upper and lower limit. Can you see that? 90,000 is between 37.5, 90 is between 37.5 and 188 or 38. So there will be marginal relief. Okay, so first term in the equation is on the right hand side. The first term will be take the TTP for that year times 25%. This is your first term, but minus the second term, which is the marginal relief. And what's the marginal relief? Is MR fraction times UL minus AP times TTP by AP. So UL here, AP here, times TTP here, divided by AP. If you do all this, you get this number. And so this 18.8 minus 1.2 is this 17.5. Is this clear? Now let's look at FY24, an example from the same thing, because what about the part of the profits that falls into FY24? So for FY24, we need a separate calculation. So we have only 3 months of the year, so we got to prorate the full profit number of 100K into a 3-month comparable figure, which is 3 by 12 into 100K, which is this. Then we need a AP figure. The full AP is 120. So the prorated AP is this, and the upper and lower limits are these. Right? Now you have to compare 30,000 to the upper and lower limits. Well, it is falling between the two limits. So there will be marginal relief once again. So let's look at the calculation here. Hopefully everything fits here. Yeah, it does. Okay, so FY24, you'll see that, yeah, we can just do this one. right? Well, it doesn't capture the full thing, right? So the right side is FY24. So you see once again, the first term will be the TTP 25K into 25%. Okay, that's this much minus the second term. The second term is this upper limit minus AP times TTP by AP. So what is the upper limit? This one. What is the AP? This one. What is the TTP? Here. What is the AP? 30K. You do all this, you get 406. That means that the net tax liability is this. So the total tax liability for this company for the year to June 2024 is 23.4 roughly. Is this clear? Okay. Everybody else, people need to nod. The only person in the class who's nodding is Lily. No, nobody's head is nodding. So I can't figure out whether everybody else has understood or not. So please nod aggressively when I ask. Okay? So it's very helpful for me so that I can understand that people are following what I'm teaching. So, okay. Yeah, so we did number 4, right? Let's look at this, okay? So effect of MR. Yeah, so you get a MR tax rate of 26.5% as long as the augmented profits remain between the limits. That is compared to what you would have paid at 19%. So it's just meant to be something that you take into account for adjustment of trading losses, of carried forward losses. But we don't have to worry so much about that, because for us, for this exam, the understanding of carried forward losses is kept to a very minimal, very elementary level. We don't have to go into details of tax loss adjustment. So that's fine. So this is just something, this information. Now, due dates of payment, I'm not going to spend much time on it. Now, one of the things you'll notice is that I have made this file. I don't know where this file is. Maybe this one. Okay, so in your folder, you will see one of the files is actually called Key Concepts. Okay, so there, what I'm trying to do, the file is not complete yet. Okay, it's not complete yet, but in this Key Concepts file, you will find that I'm trying to write down for each of the topics. It is complete for VAT. I have completed the topics for VAT, right? So this is the question of, like, you have so many topics in it. So the things you can use this as a guidepost for studying. Okay, this is like your checklist of topics, right? When you go to the supermarket, you have a checklist like, have I bought the oil, have I bought the butter, and all that. So it's a checklist for your preparation. So you can use this list of topics. But in addition, also don't forget that at the top of I haven't been able to do it for every topic, but for many of the topics, what I have done is this kind of thing, right? Like, there's a first priority memorization and the second priority memorization. So the way you study is, for each topic, first make sure you cover the required number of topics with the first priority memorization only. Don't go to the second priority because you can't remember so many things. So once you've got good preparation for all your topics on the first priority, then you can go back, if you have extra time, you can go back and do the second priority memorization, all right? So for each topic, when you're studying, you should refer to the online notes file and see if there is anything given on the top, like memorize first priority, memorize second. So look at the first priority first, and then also look at this file to see whether I have listed some topics here. So I hope to, unfortunately I'm so busy marking scripts that I don't have time to apply my mind to this, but I'm going to try to do this. We still have some time before the exam. So I'll try to complete as many as possible, right? That for each topic, this is corporation tax, Okay, this is for VAT. So I've started with some of the topics for corporation tax. So this is basically like Yumi was asking a question about what are the topics that are important for the exam. So this is meant to help you along those lines, to give you some kind of a filter to prepare these topics. Okay, so why did I come to this part here? Due date of payment. Because due date of payment, I'm not going to spend time on it because this is just information. So in the class, we don't have the luxury because there's so much to discuss that, and we just don't have the time. So whenever it's a mechanical thing, like due dates of payment, you just have to memorize. I'm not going to spend time reading out those slides in the class. Do you understand? Okay, because it's just your job is to memorize these dates. Dates of payment, so pretty much for every type of tax that you can think of, dates of payment and dates of filing return. This is understood that you have to memorize, okay? Penalties, maybe we don't have to worry so much. It's more of a secondary thing, but check it topic by topic. But one thing is clear, that for every topic that you can think of, corporate capital gains, corporation tax, whatever you can think of, okay? Due dates of payment and filing return, date of filing return. These things you have to memorize. Is that clear? Okay. So, therefore, I'm not covering this. Even the example 6 of Melville, I'm not going to cover because this is just, just read the information here because it's just mechanical stuff. Large companies, I will lose too much time if I try to cover this. So there's a large company element, okay? This is the augmented profits. If augmented profits exceed 1.5 million, so remember these definitions as well. So that's why I said that under corporation tax notes, memorize slides 84 to 85. Slide 84 to 85, okay? This part is maybe not so important, okay? But example 6 and 7, you can look at their information. So first is 9 months and 1 day. We can just maybe look at just 6 and 7, but this is not really something we need to spend time on here. This is where the information is laid out, so just look at it. So basically the large companies have to pay. So the main rule is that for most companies, it's if you're not a large company, it's 9 months and 1 day after the end of the accounting period. But if you're a large company, then you pay by installments, right? And when are the installments due and all that? So that's why I said 84, 85 you should memorize. Just memorize 84, 85. I'm not going to spend too much time on this because it's just mechanical things, mechanical information. Self-assessment is these are secondary importance. So what did I say? 86 to 92. Pages 86 to 92, again, I'm not going to spend time on because it's just basic, just information, okay? Like just information on like Dalian to Beijing is so many miles. There's no point by reading it out, you just memorize it, okay? All this stuff you just memorize. 86 to 92, I'm just going through it, okay? You just go through it and you just memorize. You see what's happening to this guy. He's trying to memorize it. He's in a great deal of distress. Okay, so it is obviously it's very painful actually to memorize. I don't know why they make the students memorize all these things, because nobody should have. We're not testing students for memorization, but in a ACCA they are testing people for memory. I don't know why they do that, but anyway, we can't do anything about it. So it's very stupid actually. You should only test people for logic and their concepts. Have they understood the concepts? So anyway, okay, I said, what did I say here? 86 to 92. I'm just going to go through here 92. You just, second priority, okay? Interest on corporation tax. Let me just go through this. Late submission, penalties, I would say second priority. All this stuff is second priority. Okay, corporate trading losses. Okay, now we have a topic here. So our understanding has to be only very minimal actually, but we do need to have this understanding because you can get a question with some corporate trading losses. So you need to know how to adjust it, how to adjust different types of. So let's look at Melville chapter 26. Chapter 26 I think is 401. Yeah, okay. So let's look at 401. So 401 would mean 411, 417, 418. Let's look at 418 and see. So you do need to have, yeah, this thing, okay? So carry forward of relief for trading losses, carry forward. So just understand this briefly, okay, how it is adjusted, because you may get a question on this. Now trade loss relief against. Now here we have to be a little careful, because some of these rules because this book is 1 year old, so don't forget that, because we are not looking at the latest Melville book. So maybe if we can find some information in the Open Tuition book, which I've shared with you, which is for the current year, so that information will be current. Maybe we can try to look at corporation. Let's look at where their information is. Corporation tax. Corporation tax, chargeable gain. So they only have a little bit of information. Self-assessment on payment of tax for companies. We're talking about carry forward of losses. So maybe it's in 135. And then there's, okay, we got this, 161. Okay, so 161 here means it's an offset of 2, so 163. So let's see if there's any information here. Yeah, so remember to put it in the current period against total profits before QCD. So if you remember, QCD is the second last line. So that pro forma for the corporation tax, which is given earlier in our slides here, the slides we are looking at, earlier in the slide we have seen that pro forma for corporation tax. That's very important. Make sure you understand that, and that is also in the Melville. In fact, you should look at the Melville structure. The Melville structure is more comprehensive than what you have in the slides. So when you look at Melville, please look at the Melville here. Here you see computation and payment. This is the computation, right? The rates of no, well, this is not the we want 24 maybe. 24 corporate chargeable gains. No, introduction to corporation tax. This one. So chapter 23. You want to look at things like maybe 347. So if we look at 347, so 357, 363, so 365. Let's look at 365. So taxable, yeah, I'm talking about this one, okay? Taxable trading profits. So please remember all these things. And then you have taxable trading profits, and then you have what is trading income. Then you'll have, there's also a larger form pro forma given in the yeah, this is the format I was talking about for arriving at TTP. But TTP is only one line of the full pro forma, which has your chargeable gains. It has the income from non-trading. So this is the taxable trading profit. This is the tax-adjusted trading profit. So this is the pro forma that is important. So let's look at the page number here, 349. Okay. So this, I would say here, very important to study the pro forma from. We are looking at which page? We have so many. I don't need all these pictures here because I've given you the textbook. So maybe I should just put it up on top, okay? Melville page, what is the page number? 349. Melville page 349. Now this part is very important, okay? What is the structure of, look at this. So this is what we are, this part you need to remember about trading losses, okay? How to adjust the trading losses for different areas, okay? So look at how they're adjusting the different trading losses. So you should remember this format, okay? This is your overall format. Okay, we have a 5-minute break. This is your overall format. So this format is very important. You must remember this format, this pro forma. This is also not given in the tax tables. This is more comprehensive than what is shown in your slides. There is a shorter version of this in your slide. This is a pro forma that you should remember clearly. And then you know where to slot in the tax loss carry forward. That's all you need to remember. You don't have to remember very good, but this format and where to slot the tax loss carry forward, that is important, okay? You know that it can be, a tax loss can be carried forward and adjusted against profit. Okay, 5-minute break. All right, let's look at now. Let's go back here. Right, this is what we're looking at. So remember to this, I put the note in the notes file. Study pro forma from Melville, page 349. All right, let's move on now. I think we're almost at the end. Loss relief is just a basic understanding, but remember that pro forma and see where the losses are getting adjusted. And do some of the examples. Maybe we don't have time to do. Let's look at the corporate tax for. Do they have any examples here? Maybe we can. Okay, so read all this trading income as well. So please remember that you're going to get a question on corporation tax, and it's going to be quite similar to what you had in your class test. Now, if you remember, I hope you guys have all seen, because I have not been able to release your scores yet, but you can already figure out your scores and what mistakes you made, because I have shared with you the test for the class test, right? So I have shared the class test with you. So please go in and study the detailed answers. Now, if you look at your previous year's question papers and answers, everything is neatly arranged. This is your class test. So please look at this answer and figure out from here. Now, this was for a self-employed case, which we did for your class test, right? Which was self-employed. And so this whole detailed computation is given. And I've given you also the page references for the correct information, right? All this I've prepared especially for you so that you can get a detailed understanding compared to that question. And the question paper is also there. So what is the mistake you might have made in the class test? So please don't wait for the grades. I'm trying to get it done as quickly as possible, but it's not, I'm always falling short on this. But you have all the information you need, basically, in terms of what mistake you made. You can figure it out from this answer key, okay? It's a very detailed answer key, and I've added more information. Where Melville, page 93. This means Melville, page 93, look for the information on the long service award. So, in the case of corporation tax, so the same kind of adjustments that you did for taxable trading profit, tax adjusted trading profit in the case of companies, in the case of self-employed, you will have the same kind of question on corporation tax. But of course, for corporation tax, the rules are slightly different. A lot of the things are the same, the basic concepts are the same, but there are some different rules. So please study those rules from the corporation tax chapters, right? Like here, this one. This chapter is very important. How to treat each of the different areas, okay? Chargeable gain is also important because you will get a question on this as well. So all the elements of corporation tax 1, 2, and 3. All three are important. This one is not so important because we need to know it only superficially, but 3, 4, 5 is very important. Okay, so Melville chapter 3.3, 4, 5. Okay, so Melville chapters, Melville 23 to 25. Okay, these are very important. Okay, so here, and please use this key. So what I'm trying to tell you is that you're going to get a similar kind of question on corporation tax, but except that here the exact rules that we have to follow are going to be slightly different. Broadly, it's the same because it has to be expense which is wholly and exclusively for the purpose of the business. Only that can be deducted, all right? And so that general principle will remain, but there are some specific rules for corporation tax. That's why I told you, look at chapter 23, 24, 25, all right? And you keep on practicing, and if you have any doubts, you just post your question in the WeChat group and I will respond. So, yeah, so that's very important. So what I was trying to tell you is, why did I get to that point? Yeah, loss relief against total profit. So basically you have to look at that pro forma, which I showed you, page 349, and then remember this, practice this. So check your mistakes from this. You're going to get a similar kind of question, but this time on corporation tax. But the adjustments you have to add back, then all the things you did here. Like here, remember, there's an important thing which we had to learn about, the lease, long-term lease. Where is the suggestion scheme I said here? There's also information about the long-term lease. Where is the information on the long-term lease? Oh, that's the second question. That's the second question. Long-term lease, okay? Here, this lease premium. This I had already explained in detail in the class. So all these things, remember, so whatever you learned in self-employment, tax-adjusted trading profit, okay, all of those most of the same kind of questions arise in corporation tax. Mostly the treatment is the same, but there are some differences which you figure out by reading your chapters. All right, is that clear? Okay, are you following what this is? Okay, so please make sure you revise. So I hope people are not waiting till getting the score, because you can easily figure out the whole thing from highly detailed working of the answer with all your references also, what is the reasoning and all that. So please make sure you understand every element of the question you got in your thing, plus the reading on the chapter on corporation tax. Right, okay, so we're almost done on this. We can move on to VAT, right? So you can just understand this briefly here. Before charitable donations, because there is in the format you'll find that charitable donations is it's like the second last line. After that you have the deficit on non-trading loan relationships. Okay, so these are some basics. We don't need to have, as it says here, corporation tax is only basic awareness. You need to know where to go, where to adjust it, at what stage of the pro forma, and that's it. So that's the end of your of this. We'll move on to the next topic, which is VAT. All right. So this is our last topic. So hopefully this is like our week 10, and then we have one more week left. So hopefully I can finish quite a bit of VAT here, and then we'll wrap up the last part of VAT, and then we'll do some question practice in the last week, which is week 11. Right, let's look at VAT here. So chapter 29 and 30, we have the book. Right, okay, so what is VAT? VAT is basic. You don't have to know about all this history. You just need to know the basics of the VAT, the rates that we have now. And I think that too, the rates are actually given in the tax tables, maybe. Where are the tax tables? I think it's here somewhere. Yeah, so if you look at VAT, yeah, okay, not much is given actually. The rates are not given, so you need to remember the rates. It's only the registration and deregistration limits that are given for VAT. Anyway, we will refer to Melville again. So 29. So let's look at, we will need to refer to the Melville for 29. VAT is 29. So let's look at page 455. And 455 means basically 471, I think. Yeah, VAT. Right, so VAT is essentially a sales tax, okay? You might have seen it. I mean, I can't read the invoices here, so you can check. I'm sure you know whether there's a VAT in China, there is a sales tax. Most of the countries now have the sales tax administered as a VAT, a value-added tax, which means that the people in the intermediate parts of the value chain can claim the input tax credit. Okay, so basically what it is that so what it is here, I'll just show you some of the information in the VAT slides. The concepts are not very well explained. I'll just tell you how to think about VAT, value-added tax. It's a tax on domestic consumption. Okay, it's a tax on domestic consumption. Very important to pay attention here, because this is not given in either in the textbook, not in the Melville, not in the Open Tuition, or in the slides. Okay, so this is what I'm explaining this. I've written this to make it easier for you to understand, because otherwise VAT can get very complicated. So it's a tax on any kind of domestic consumption. That's why you notice I said final or intermediate. What is intermediate consumption? Intermediate consumption is when, let's say, Foxconn makes some iPhone parts and then sells it to Apple. So Apple takes those iPhone parts and puts it into the iPhone itself. So Apple is an intermediate consumer of the whatever iPhone parts they're making. So that's intermediate consumption, because it's not the final consumer. The final consumer of the iPhone will be the person who goes to buy it, okay, at the Apple store. That's the final consumer. So it's a tax on domestic consumption. It can be final or intermediate, okay, and there are some exceptions for international trade and services. Okay, but it's a tax on domestic, final or intermediate consumption. But one important thing is that, why did I say intermediate and why did I put a star on it? Because although there is a tax on intermediate consumption on a gross basis, well, actually they pay it on a net basis. The idea is that the full tax burden is only incident upon the final consumer. Okay, so these are certain basic terms, the technical terms from finance and economics that you need to understand. When we discuss tax and economics, we talk about the incidence of tax. So the incidence of tax is different from who is administratively paying the tax. So when you go to the Apple store, let's say there's a 5% sales tax on iPhones, right? So if you go to the Apple store and buy an iPhone, okay, then you pay 5% extra based on top of the sticker price. You pay 5% extra. If the price is 100, you pay 105. So that 105 is actually being collected by the Apple store, by the seller, but it will be paid by them to the government. So they're just collecting the tax. But in this case, actually, you are paying the tax. You're the final consumer. So what I'm trying to say is that incidence of the tax burden. Incidence means economically, when you do the analysis after netting everything out, who is paying the tax? The tax is fully incident upon the final consumer. You'll see this from the example of the quarry. So remember this, because it will help you in the future. Because what happens to the intermediate people, you'll see that they can claim what is called input tax credit. They're able to claim input tax credit. You are going to get a question on the VAT. It's going to be in section B. It's an optional question, but you should study VAT properly, because if you are able to crack it, then it's an easy way to pick up marks in VAT. So you know that you're definitely getting a question on VAT. Okay, so I have also given you one more element here. If you look at one more thing here, I also found that people were not aware from yesterday when I was having the discussion with the other group the day before yesterday. That is, if you look at this, I have also posted something else, which is here. Revision question bank and exam guide. This is what we try to do in the class next week. Here's an exam guide, okay? Exam PPT, all right? So please check this out, the exam PPT, which is telling you how many questions, like they were asking how many questions on what topic, etc. All that information is given in the exam PPT, all right? So please check it out. I may not cover the exam PPT in the class myself, because again, it's just information, right? So we don't have time to just cover information in the class. You just read it yourself, because it's very clear. one question on corporation tax. In part A, one question on corporation tax, one question on employment income, and one question on capital gains. So there's no point my reading it out in the class for you. Just read it in the exam PPT, you'll find it out, okay? So you prepare the, so all this information is there. Sometimes sometimes I think that students are not tracking every announcement in the WeChat group. Every time I post something important, I'm making an announcement in the WeChat group that I posted this information. But I see that people are not aware of all this, so I just wanted to make sure that you are aware of all this. All right, let's go to VAT. Let's go to this concept of VAT. Okay, so as we say, the input tax credit. Let's look at the example. We'll get an idea from here. Let's look at this example here. Okay, so scope of VAT, before we get to this inputs and business, yeah, let's look at this thing, then I'll come down to the quarry part, yeah, so let's look at this example from Melville page 455. Okay, so there are three companies, A, B, and C. A is taking out the stone from the quarry and selling the stone directly to B, but they are extracting it, so they're adding value. Okay, so why is it called value added tax? Because you have like a value chain. Have you heard this term called value chain? Have you heard this term called value chain? Anybody? Yes or no? Value chain is just the production, is like the production chain from the raw materials, some further processing, then from further adding additional materials, and then you get the final product and it goes to the consumer. So all the way up to the consumer is the value chain, right? So this is like a value chain example, right? So this guy owns a quarry, he takes he's at each stage somebody's adding some value. So he's adding value by extracting the stone, because B can't extract the stone. So B relies on A to extract the stone. Then sells it to B. B does something. B converts the stone into paving slabs, right? And so sells it to C. C can't do this part, so B is doing it. And then sells it to C. What is C doing? What is C's value addition? C is just a retail shop, like an Apple store. It's just a retail shop where they collect all kinds of different kinds of slabs from different wholesalers, and they display it in their garden center. So that's also a type of value addition. They are providing a kind of a aggregation service for the consumer, right? So everybody's adding some value at different stages of the chain. This is why it's called a value chain. You'll notice that in your value added tax, I have used the value chain example, which is that, well, even from FA24 actually, is the example 1 is the value chain example, which is example 1, which is page 455. Okay, we can say example 1 gives you an example of the value chain, right? So what is a value chain? You can see this here. So these are the prices at which they are selling. This guy first he sells at 10,000 plus VAT, 18,000 plus VAT, and the last guy sells to the general public at 32,000 plus VAT. Now what am I saying here? So it's a tax on, as I said, VAT is a tax on domestic consumption, whether it's intermediate or final. All right. Now these are all examples of intermediate consumption. When A is selling to B, it's a case of intermediate consumption by B. When B is selling to C, it's a case of intermediate consumption by C. Because C is anything who is any consumption which is not the final consumption, that is called an intermediate consumption, right? So B and C are intermediate consumers. Finally, C will sell it to somebody for 32K plus VAT. That's the final consumer. So whoever is the final consumer there is the final consumption, okay? So what you will see the example that I mentioned. You can see that VAT is being charged at every stage of the consumption. Every time there is consumption, VAT is being charged. Can you see that? That when A is selling to B, intermediate consumption, there is VAT being charged, 20%. The standard rate of VAT, as you will find out, is 20%. So B is being charged 20% VAT, and A has to pay this to HMRC. A has to pay this output tax to HMRC, but A is not losing any money out of pocket because A is not paying this 2,000 out of his own pocket. A has charged this amount to B. So when B came to buy, he said, okay, the price is 10,000 plus VAT. The VAT is 2,000. So A collects the 2,000 VAT also from B and pays it to the government. So A is not losing anything. He's just collecting the tax and paying it. So no incidence on A, no final incidence on A, because he's not really paying it. Maybe we can change the, I don't want to use the word final incident because it's already the final consumer. So now you'll see what I mean here, okay? Now, B, what is B doing? B, remember, he had to pay 2,000 VAT here. Now B, what does he do? He buys at 10,000 here, this one, and pays 2,000 tax. So he remembers this. He has not forgotten this because he's going to claim back this 2,000 because B is not a final consumer. He's an intermediate consumer, so he's going to claim back the VAT that he paid on all his inputs. So he paid 10,000 plus VAT, so he keeps a note of this, that I paid 2,000 VAT, I need to get it back. Then he sells to C for 18,000 plus VAT. So the 20% VAT on 18,000 is 3,600, right? So he charges 18,000 plus VAT. So he collects this plus this from C. He collects this from this plus this from C. But notice that he although he collects 3.6 from C, he's not paying 3.6 to HMRC. He's paying 1.6. What is 1.6? It's 3.6 minus the 2,000 that he has paid earlier to A. He needs to recover it. This is called input tax credit. Okay, when you adjust your gross VAT liability by the amount of input tax you have paid, that is called the input tax credit. Here's the input tax credit that is being reflected here. That the difference between this and this is the input tax credit. So again, you can see that B is not losing anything. The 3.6 he collects from C, so it's not coming out of his pocket. The 2,000 did come out of his pocket, but when he collects the 3.6, he recovers the 2,000 because to the government he's only going to send 1.6. So the 2,000 he had to pay out of his pocket to A, he's going to get it back by holding back 2,000. That's your input tax credit. Now C also, C is paying this much VAT. So C remembers it, he keeps a note of it. Then C sells to the final consumer at 32K plus VAT. So it's 6.4. So, but will C pay 6.4 to the government? No. C will pay on the gross basis, C has to pay 6.4, but C wants to claim input tax credit for this amount that he had to pay to B. So C, being an intermediate consumer, can also claim input tax credit. So therefore, what will C pay to the government? 6.4 minus his input tax credit, which is 3.6. That number is 2.8, right? So you can see that the government eventually gets a total of 6.4. And who is the poor guy who has to pay the 6.4? It is the final consumer. The final consumer has to pay the full 6.4. Everybody else is not losing anything at all. C is not paying anything out of his own pocket. He had to initially pay 3.6 out of his own pocket. But when he got the 6.4 from the consumer, he didn't give the whole amount to the government. He said, first let me recover what I had to pay out of my own pocket, which is 3.6. So from the 6.4, I will recover this and I'll pay only the balance to the government. Do you understand? So none of these guys, A, B, and C, none of these intermediate people in the value chain, they're not paying anything out of their own pocket. So that's what I mean by saying, who is the poor guy who pays the full tax and cannot claim anything? It's the final consumer. So the full tax burden, which is 6.4, is incident on the final consumer. Okay? Incidence means it's a technical term in economics for the person who, in an economic sense, finally bears the burden of the tax. Here you can see it's the consumer. It's the final consumer. All right? So this is a very important thing to remember also. Tax on domestic consumption. It will be very helpful later on when we look at import-export transactions. All right, now you understand the structure of VAT. Okay, let's look at some definitions. Taxable person. When does a tax to, let's go up a little bit and let's look at all this stuff. Yeah, the scope of VAT. Okay. A taxable person making taxable supplies. So let's look at these definitions. Two important definitions: taxable supply, taxable person. Okay, let's look at taxable person first. Taxable person is a very wide definition. If you remember in your previous semester, we studied about legal persons. We studied natural legal persons and artificial legal persons, which are companies, right? Here, the definition of person under VAT is very broad. It includes partnerships. Partnerships are not normally considered legal persons in the strict sense. But here, in the case of VAT, a person definition of a person is a very broad definition. It's pretty much anyone selling anything for a price. Okay, anybody selling anything for a price is basically chargeable to VAT. There are some exceptions like museums and art galleries, etc. So that's a different type of exemption, but so a taxable person is a person making taxable supplies, okay, who is or should be registered for VAT. And what is a taxable supply? Now here it's useful to refer to your calc file where I've tried to make this distinction clear here. Here, what is a taxable supply? So a taxable supply is any supply of goods or services which is not exempt. So the taxable supply is defined in a residual manner. Okay. So you understand the term residual? I think I mentioned this somewhere here. Yeah. So three things here. When you look at the VAT topic, there are three residual definitions: taxable supplies, standard rated supplies, and supply of services. We'll come to them one by one. What is meant by residual? Do you know what is meant by residual? Residual means that leftover basis, or whatever is left over. So when you drink coffee, there's something left at the bottom of the cup, that's a residue. So residual means whatever is left over. So if one way to define let's say home student at Duffy. If we define a home student at Duffy at anybody who's from Liaoning province, then we can define the away students as anybody who is not from Liaoning province. So we don't have to name the province. If the province is he's not from Liaoning, then he is classified as a out-of-state student or something like that, right? So that's a residual definition, because we only care, if you're not from Liaoning, then you are a out-of-state student. So out of province student. So that's a example of a residual definition. We're not defining you directly, but indirectly. So that's an example of how we define taxable supplies. We talk about any supply of goods and services, and if it's not exempt, so there is a list of exempt supplies. So what is a taxable supply? The taxable supply is any supply that is not exempt, like you'll see here. See, a taxable supply is any supply other than that is which is specifically exempted for VAT. And so there are three rates of VAT, as you will find out. It's a standard rate of 20%, 5%, and zero rate of 0%. So these numbers you have to remember, because zero rate obviously is obvious. 5% is the reduced rate. You need to remember because they're not in the tax tables. All right. So taxable supply is anything which is not exempt. So you should also have some idea. I've given you the page numbers. 458. I think it is 458. If you look at 458, yeah, I think the number is correct. Yeah. You see there's a list of exempt supplies. So what is a taxable supply? If there is a supply of goods and services and it's not covered by this list of exempt supplies, then it's a taxable supply, right? So it's like, who is an out of province student? If he's not from Liaoning, he's an out of province student. We are not really going to calculate, we'll find out which province he's from. As long as he's not from Liaoning, he's an out of state student. So that's basically the idea here. Exempt supplies, have some idea about these, which are listed in the Melville textbook, and especially those which are listed in your slides. So when it comes to VAT, one important thing you have to remember is what are the zero rated and standard rated supplies. Let me see what I have done here in terms of the VAT guidance. What have I said here? Yeah, see, in the VAT guidance it says main types that are zero rated, standard rated, or reduced rated, which are especially mentioned in the slides, okay, in the slides and the textbook. So you have to have some idea about these. So you can see that, yeah, so once again you see that supplies of goods and services, if it's not exempt, then it's taxable. And taxable supplies are of three types: zero rated, reduced rated, and standard rated, right? And again, you'll see this also, you should have some idea. The zero rated supplies, there's a list on page 459. So on page 459, you'll find a list of zero rated supplies here. Zero rated supplies. And then this is reduced rate supplies, also given here, okay? So some basic stuff like these are all quite important. You see these are mentioned in the books, in the slides as well. Books, newspapers, children's clothing. Children's clothing is not mentioned here, but it's there in the slides, I think. Food, non-luxury food, etc. So you should have some idea about what these are. Now, what is a taxable supply? What is a standard rated supply? Again, that's a definition, that's a residual definition, as I mentioned here. Standard rated supplies are also a residual definition. You notice that under standard rated, I have not given any list number on any page because they have not listed the standard rated supplies. What have they said? They said that if it's a taxable supply, and what is a taxable supply? Well, if it's not exempt, then it's taxable. So there is only a list, there is no list of taxable supplies. There's only a list of exempt supplies. If it's not listed in the exempt supply, then it's taxable. If it's taxable, it's either zero rated or reduced rated, for which you have specific lists. Now, under taxable supplies, what are the standard rated supplies? Well, we don't know, because it's any supply, any taxable supply which is not zero rated or reduced rated, that's standard rated. That's the definition of standard rated. So that's also a residual definition. You need to understand these ideas. Okay, so let's look at this, zero rated supplies. Now let's look at taxable supplies. Now we are talking about supply of goods and services. So there's a second categorization, which is goods versus services. Now supply of services is also a residual definition. You see there is no list of services of supply of goods. There's no definition of supply of goods, but there's no good supply of services. Any taxable supply which is not a supply of any supply which is not a supply of goods is a supply of services. That's how they're defined it. So on page 457, you can see supply of goods. Ownership of goods is transferred from one person to another. That's when the supply happens, because we need to know when the supply happens, because as soon as the supply happens, remember, you have a tax event. You have what is called maybe a tax, we can call it a tax point, which is a more specific term, but we can call it a taxable event for VAT purposes. If a taxable person is making a taxable supply, and if that supply of goods that is happening, as soon, why do we need to worry about when this happens? When the ownership, the definition, we need to keep this in mind, when the ownership of goods is transferred, like the title is transferred. Okay, why is that important? Because as soon as the title is transferred, a supply has occurred. And when a supply has occurred, we have to check, is that supply exempt? If it's not exempt, then it's taxable, right? So that's very important, because then we have to immediately register that fact that is taxable, and then in that same quarter we have to pay the tax and report that transaction, right? So that's why it's important to define the supply of goods, right? It has to be made for a consideration, because we said that definition of taxable person also is a person who, any kind of entity making a supply of goods for goods or services for consideration. Consideration, if you remember, the definition is given here, but this is a very narrow definition. We had given you a much broader definition under contract law in the previous semester, if you remember that, right? So any kind of detriment that you suffer can be treated as consideration. So we have to watch out for this. Now let's see here. So goods and services. Then you also have mixed supply of services. You have mixed and supply. You have other definitions of supply. So you have self-supply also, which is we will deal with later, right? So we can just leave it at this, goods and services at this point. We'll move on from here. It has to be business related, okay? So that's another element of VAT, which is very similar to the concept of deductible expenses for a business, which is what kind of expenses are deductible, which are those which are wholly and exclusively for the purpose of the business. Other than some general exceptions like what you see here, that private use of a business motor car is not considered a taxable supply, okay? So, but other than these kind of exemptions, generally the same rule applies for VAT, that we are only going to allow input tax credit on business supplies. If it's for the if you're using it for personal use, there will be an adjustment, and you can't claim the input tax credit, at least not on a net basis. All right, so you'll have to do something like a self-supply type, okay, which is where in this case you have to show the input. You can claim the input tax credit, but you have to again charge the output tax notionally to yourself when you've done a self-supply, which is a individual consumption, etc. Okay, so let's look at it. Business has to be carried on. So in your VAT return, you will have two panels. You have an upper panel for output VAT, and you'll have a lower panel for input VAT. So output VAT is whatever you need to pay to HMRC, and the input VAT is whatever you're going to claim from HMRC, and so the net of the two is what you have to pay. So in the exam, you'll have this kind of format, like here, what I've shown you here, this kind of format. Okay, so output VAT on top, okay, whatever is the output VAT, and whatever is the input VAT. Now here I've shown only one item each, but in practice you will have many items. There'll be like 5-6 items in each of the panels, and you have to show all of them, and then you take the total of that. So every quarter you pay this is a tax period, net it out here. So you buy goods, you're paying input VAT, but you can claim it later as a credit. And when you sell goods to the final consumer, you receive, or any consumer actually, you pay, you receive the output VAT from the consumer, final or intermediate. Okay, A Limited owns a quarry. We have already done this example, so that's fine. We already saw this example, so we don't have to worry about it. This again shows you the total tax being paid to HMRC is actually being borne, is finally incident only upon the final consumer. Okay, so 3 types of supply: zero rated, so reduced rated, so you need to remember the tax rates. Okay, now zero rated supplies are still considered taxable supplies, so please remember that. So one of the questions you can get is, what is the difference between a taxable supply and an exempt supply? All right, so this is the second important point which I had put in there. Okay, taxable versus exempt supplies. All right, what is the difference, right? So exempt supplies, essentially you don't get to claim, I think I put that, distinguish with. So taxable versus exempt supplies is one distinction, okay? There's another distinction between zero rated and exempt supplies. So please remember that zero rated supplies are actually falling under taxable supplies, right? So the zero rated supplies are falling under taxable supplies. So what is the difference between zero rated and exempt supplies? Because in both cases there is zero VAT being paid. Exempt supplies, VAT being paid is 0. On zero rated supplies also, VAT being paid is 0. But there is a difference between the two things. Zero rated supply are a class or species of taxable supply. But this is an exempt, these are exempt supplies. Remember that these, the VAT return only applies to taxable supplies. So if you're making exempt supplies, what happens is that you'll see this mentioned as elsewhere also in the textbook. If you're doing exempt supplies, you don't have to file a VAT return. You don't have to file a VAT return, but the problem is, because you don't have to file a VAT return, you can't reclaim the input VAT. You remember what was happening here? That in this example here, you see what is happening here? All these guys, they're able to claim, they're collecting 3.6 but paying only 1.6 to the government. Why? Because they're showing a VAT return, because they are a business making taxable supplies, they're showing a VAT return. On top, they're showing the output VAT, which is 3.6. At the bottom panel, they're showing the input VAT, which is 2,000. And they're netting out the 3.6 minus 2,000 and paying only the 1.6 to the government. So that's the meaning of being able to claim the input tax credit. But you only make a VAT return if you're making taxable supplies. So the problem of making exempt supplies is you don't have to file a VAT return, you don't have to charge VAT. But if you're making exempt supplies to customers, but maybe you have some inputs on which you're paying VAT, well, you can't claim the input VAT on that. That's the problem. You can't claim the input VAT on if you're making exempt supplies. But if you're making zero rated supplies, you can reclaim the input VAT. So when you're in a zero rated supply situation, maybe your final output is zero rated, but maybe some of your inputs have some standard rated VAT which you have paid. So because you're making taxable supplies, which are zero rated supplies, so over there on the top panel you will show zero VAT to be paid, because zero VAT has been charged, because these are all zero rated supplies. But because it's a taxable supply, you can file a return and you can reclaim the input tax that you paid on some of your inputs which are not zero rated. Is that clear? Is the idea clear? Okay. Again, I'm looking to Lily because nobody else is nodding. No one else is nodding. Is this idea clear about claiming the input tax? Yeah? Okay, good. So, so that's the difference. So one thing you need to remember is the difference between exempt supplies and zero rated supplies. You need to remember that difference. Okay, and what are the implications of that? Which is that in the case where you're making exempt supplies, no tax return, and then you can't claim the input tax credit if you have paid some VAT on those inputs. All right, let's move on from here. Yeah. So you need to remember some of these things you need to remember. Okay. Okay, we have a 5-minute break. All right, let's start the last part. Okay, so zero rated, please remember to take some examples, remember some of the examples which are cited in the slides, okay, on different types of zero rated supplies, reduced rate supplies and standard rated supplies. So this distinction we have already discussed, and I've already shown you the list because we discussed the layout on your calc file, okay, the classifications. No more talking, please, Miliko. No talking. Once the class starts, nobody should have no conversation should be going on. I don't want to hear any background noise. It's very disturbing for me. Okay, so some of these things, anything which is mentioned in your slides, and preferably also in the textbooks, whatever is mentioned, examples of zero rated and examples of standard rated. Not example. There won't be an example of standard rated, but some examples are given. But zero rated supplies and reduced rate supplies, any examples given, exempt supplies, examples given in the slides and in the textbooks. Most importantly, what is given in the slides, and then second importance is from the textbook. Please remember some of these examples, like kids' clothing, non-luxury food, books and newspapers. They often get examples. You'll often get a question in the exam which will say that this person was selling books and newspapers. He sold books and newspapers to UK customers. Well, books and newspapers are zero rated. That information will not be given to you. You need to know that books and newspapers are zero rated. So on books and newspapers, you don't charge standard rated VAT, you charge zero rated VAT, okay, zero VAT. So you need to remember some of these examples. So you're also being tested on your knowledge of some of the common examples of zero rated supplies and reduced rate supplies and exempt supplies, etc. Right, so types of supply, we have, okay, here are some more examples. Accountancy fees, these are standard rate supplies. So normally we don't give examples of standard rated supplies because they're defined by, they are a residual definition, but wherever some examples are given in your slides, very important. You must remember every type of example given in your slides. Accountancy fees, that's a standard rated supply. So if you get a question on, okay, so and so paid accountancy fees of this much, well, you know that the VAT on the accountancy fees is standard rated, which means they must have paid 20% VAT on it. So you can reclaim the 20% VAT, right? So don't write it as 5% or 0%. So there's examples of, new books are exempt, wages are exempt, but accountancy fees are standard rated taxable supplies. Okay. Here are some other concepts of value of a supply. Now, here I said slide 12. Please ignore the information in slide 12. I've mentioned this in your notes, so it's important to read the notes as well. Where did I write this actually? Where did I write this? I wrote this down somewhere because there's wrong information actually in slide 12. Slide 11. Yeah, this one, okay. So let me mention for slide 12. Ignore the material on slide 12 barring the VAT fraction. This information is not correct. It is not the consideration. The price before VAT is just the value of the supply, okay? So there is the VAT exclusive amount or value of the supply. So there are a few definitions, okay, which is the VAT inclusive price is equal to the consideration. So if you look at the I've given the reference to see the material on Melville page 460. So let's go to page 460. Yeah, value of a supply. This must be page 460. Yeah, it's page 460. Here, look at this. So let me show you the basic common terms you need to understand. Okay, the value of the supply is the amount on which the VAT is charged. Okay. This normally will be the price before VAT or the VAT exclusive price. So the value of a supply can also be called VAT exclusive price. So you can say that we can also call this here. I think I mentioned this. Yeah. So value of a taxable supply is the VAT exclusive price. All right. And the other thing is the word that we use is the value of a supply and the consideration for the supply. The consideration is the VAT inclusive price. So the consideration, if you remember from your previous contract law lessons, is the consideration is the total detriment. Again, please don't talk in the class. When any kind of no discussion once the class is in session, unless you're asking a question, there should not be any discussion. Okay, so yeah, so see, I've lost my thread because I find it very distracting. Whenever I hear any kind of talking going on, we have so little time. Yeah, so we have the concept of value of a taxable supply, which is equal to the VAT exclusive price. Then we have the consideration, which is the VAT inclusive price, which means that it is the value of the supply plus the VAT. If you add the two, you get the VAT inclusive price, which is also called the consideration. If you remember consideration from your previous semester, how did we define it? It is the total loss or detriment that you have to give up or suffer in order to get the other party to the contract to perform or agree to perform his part of the promise, right? So it is whatever you're parting with fully, right? So when I go to McDonald's and I pay, say, 10 RMB for a coffee, now some of that 10 RMB may include a sales tax, but for me the consideration is the full amount including the sales tax. So that's the consideration. Okay, so it's a 10 RMB for me in that case. All right, so ignore this material on slide 12 because there's a mistake there. The mistake is that they have referred to the price before VAT as the consideration. That is not the consideration. It is the VAT inclusive price that is the consideration. Okay, maybe there's a slight, the typo or something in the slide. Now, the VAT fraction we do need to remember. We can study it from the textbook. There's also something called a VAT fraction. For standard rated supplies, we normally only consider the VAT fraction for standard rated supplies. The VAT fraction is very useful because here we have, so if you see standard rate of supply, standard rate of supplies is 20%, okay? Standard rate of supplies is 20%. So if you have something which costs which is the value of the supply is 100 pounds, if you apply 20% VAT, that becomes 120 pounds is the consideration or the VAT inclusive price. So the VAT fraction is the number by which you multiply the VAT inclusive price in order to arrive at the VAT amount. Okay, so what is the VAT fraction? The VAT fraction is 20 by 120, which is 1 by 6. How do we use the VAT fraction? We take the VAT fraction and we multiply let me write it here, otherwise it's not very clear. Okay, let me write it here. The definition should be given in what is the VAT fraction? VAT fraction, we define it like this as VAT fraction times the consideration or the VAT inclusive price. VAT fraction times the consideration or the VAT inclusive price. Okay, we will not put the consideration because we want to fit everything in one line. But you know that consideration is the same as the VAT inclusive. So VAT fraction times VAT inclusive price is equal to VAT. Is this clear? Okay. VAT fraction times VAT inclusive price is equal to VAT. That's what we use it for. So the VAT fraction is 120 by 20, 20 by 120. The VAT inclusive price is 120, and so the VAT is 20. Okay, so that's how you get it. So if somebody tells you that the VAT inclusive price is maybe, right, so if they say the VAT inclusive price is maybe say 355 or 357. If the VAT inclusive price is 357, I've given an example on top, so let's use that, okay? So VAT fraction, okay, so there's your VAT fraction is 0.17. 0.17 is nothing but 1 by 6, okay? So VAT fraction is this, so the VAT inclusive amount is this. So if you take the, here, you can see how I've defined it. So if you multiply the VAT inclusive price by the VAT fraction, you get the VAT amount. Okay, you can do it for any amount. So if we have a price of, let's say the VAT inclusive amount is say 356, then what will be the VAT on this? Well, the VAT on this is going to be 356 times this. Is this clear? The VAT fraction. Now, I'm taking the VAT inclusive price and I'm multiplying it with the VAT fraction. That's my VAT. Okay? Why do we need this VAT fraction? You will need it in the exam also, because most likely in your question you're going to get some question which will say that the VAT inclusive price was so much. And then, so in that case, you have to write in your input tax credit column, in the panel for input tax credit, you have to write the VAT fraction. You have to calculate the VAT amount, because that's the amount that you're claiming. So what is the amount that you'll claim? You'll take the VAT inclusive price and you'll multiply it with the VAT fraction, and that will give you the amount of VAT, and that's the amount of VAT that you will be claiming back. Do you understand? That's why you need the VAT fraction. So the VAT fraction normally we only discuss for standard rated supplies. All right. Let's try to move on and cover a few more topics. Here. So, standard rated supply, the value of supply is 180. What is the VAT charge and the consideration? Here the definition is correct. So the value of the supply is 180. On that you have standard rated supply, 20% VAT. The VAT is 36. And the total consideration is 180 plus 36, which is 216, right? Once again, if you take 216 and you apply the VAT on it, you apply the VAT fraction. If you take 216 and apply the VAT fraction, you should get 36, which is the VAT amount. You see? 36, okay. Standard rated supply is made for a VAT inclusive price of 1740. Yeah, this is the kind of application. This is where you need the VAT fraction. Okay, so if the VAT inclusive price is 1740, then the VAT element will be 1740 into 1 by 6, which is this. And the value of the supply is 1450, which is this minus the 290. Is this clear? Yeah? Now, here you have to take, so there'll be some examples of some questions. You might have a case where the customer is given, like you see here, that the customer is offered some kind of discount. The customer is offered some kind of discount where if you pay within 30 days, you get some amount of discount. You get a 3% discount in this case. So in this case, whenever you see that usually in the exam there'll be a information saying that this seller is providing a discount of 10% on the value of the supply to those customers who are paying within 30 days. And then they'll say that about 30% of the customers paid within 30 days. So in that case, you have to take the VAT, because those customers who are paying within 30 days will get a 10% discount. So they will only pay the value of the supply times 0.9, right? Here you can see what is happening, which is, in this case, 4,000 plus VAT is the standard rated supply. You get a 3% discount if you pay within 30 days. Calculate value of supply and VAT charged at 20% if the customer pays within 30 days. So if he pays within 30 days, that means he's getting the 3% discount, right? So then what is the VAT in the case of A? Well, it's 4,000 minus 3% of 4,000, which is 3880, okay? Which you see basically is 0.97 into 4,000. So it's basically, if you see here, it's maybe this one, yeah. You see here 4,000, I've done this example here, it's actually slide 14. Okay, so let's look at this as slide 14. So it's 4,000, 3% is the discount. What is 3880? So it's 1 minus 3%, you get a discount on that. So 3880. And on that you have to charge the VAT. So you charge 20% VAT on that, which is 776. All right. You can see this, which is, so the net, this is the factor for the consideration. This is the consideration, right? So if you can put maybe we can put a right click here. Yeah, and we can call this the discount, okay? Then this is the, this is the value of the supply. Value of the supply, then this is the multiplier. Now this is the consideration. What is this? This is basically the value of the supply times 1.2 to give you this. This is the consideration, okay? Or we'll call it the VAT inclusive price. The VAT inclusive price, the VIP, all right? This means VAT inclusive price, and this is the VAT, right? So VAT inclusive price, the VAT is basically the VAT inclusive price minus the value of the supply. Is this clear? Yeah? Example? All right, okay. Now here, when he doesn't pays after 30 days, then you don't get the 3% discount. So in that case, you have to charge 20% on 4,000, that's 800, and the consideration becomes 4.8, right? So this kind of thing, also be very careful if there's any information in the exam question about people are getting discounts if they pay within 30 days. So make sure you adjust for that. All right, let's look at the next one. Own use, goods for own use, you have to account for on the replacement value, that's fine. But this is where you have to do it like this, okay? So, like here, what I've shown you. This is going back to what was shown in the, what was there in the self-supply, right? If you remember earlier, we were talking about self-supply. Here you can see, yeah, self-supply, 457. Okay, so let me talk about this here. Self-supply is here you can. So it's not a perfect example of self-supply, but it is actually true. That so if you buy, let's say I'll give you an example here. I will say here also, let's take what slide are we talking about? Slide 15, let's say. So let's put a number here, and let's make it like slide 15, and let's make this slide 15. All right. Now, here we will say that C also, we also say that C also Melville page, what is the page on Melville we want to look at? 457, okay? Self-supply. All right, so okay, so you can recover. So this is the format of your VAT return. This is the basic structure. Here I've shown only one item, but you will have many items in each of the panels. So if you take, let's say that they have some supplies. Now this is also very important because you can get questions like this in your exam. They will say that they bought some supplies for the business. Maybe it's a grocery store. You saw some examples earlier. It's a grocery store where maybe they bought like 1,000 worth of sugar. They bought 1,000 worth of sugar, but then 300 worth of that sugar the owner took for his own use. So you can't actually get on a net basis. You can't get net basis claim for input tax. If you bought 1,000 worth of sugar, then on that you paid 20%, which is the 20% here, like the standard rated supplies, right? So if you have this, right, and you have to pay 20% on that, okay, that's your input tax credit. So you bought 1,000 worth of sugar and you paid 20% VAT on it, so you kept track of that VAT. So this is the value of the supply. Here we can again write value of the supply, and here is the VAT. All right, here is the VAT paid. So here you can see that you have paid 200 VAT, so ordinarily you'll be able to claim 200 VAT if you use the full 1,000 of the supply for your business. But in this case, we didn't use the full 1,000 for the business. The owner took 300 worth of sugar for his personal use. So here we can treat it as like a self-supply, where what happens is, so basically the government will disallow the claim for about 300 of the amount. How did they disallow it? There are two ways to do it. You can either write this as 7,000, you can either write this as 700, which is 1,000 minus 300. So you only claim the input tax credit on the part that is for the business. So be very clear about this when you're doing this kind of question. And there's any information that the owner took some material for his own use, or there is some private use of mobile phones, like you'll see that also being mentioned. Private use of mobile phone is mentioned later on in the slides. So any private use of mobile phones or those kind of things, right? So we'll give examples for both of them, let's say, right? So if you bought the sugar worth of 1,000, you paid 200 input tax credit on the VAT on it. Well, in the input tax credit, in the input VAT column, you can write 200, but since the owner took 300 of the goods, you have to do a self-supply to the owner. Although the owner didn't actually buy it from the business, he just took it, but you have to show it as a self-supply. So you have to show output tax sold to the owner. You have to say sold to the owner at 300, so 300 worth of goods. And what is the VAT on 300? As 60%. So now here, you have to pay whatever is in the output VAT. You have to pay to HMRC. Whatever is in the input VAT, you can claim from HMRC. So the net claim on this here will be only. So the net claim will be only 140 will be claimed. You understand? Here only 140 can be claimed because you have to show the amount that the owner took like this. And so another way to show 140 is also to do, you can also just do it like this. You can just say that, okay, I bought 1,000 worth of goods for the business but the owner took 300, so I can't claim for the full 1,000 the input tax credit. I can only claim for 700, and on the 700 I will pay 20% tax, which is 140. Either way you get to 140 is what you can claim from the government. This is clear? Same concept, remember this for mobile phones, right? So mobile phones, remember that if you remember your employment income, and this is also relevant because you might get a question in the exam for employment income, and they'll say that they got one mobile telephone for personal use also. But remember that one mobile telephone under employment income for benefit in kind is exempt. One mobile telephone is allowed even if it's for business personal use. One mobile telephone under employment income benefit in kind is exempt. But under VAT what will happen is, suppose you bought the phone, okay fine, you bought the instrument because it belongs to the company. When the employee leaves he has to give it back to the company. So that you can claim the full VAT, okay? So then here we can write this here. Again, we are discussing slide 15. We are still discussing slide 15, where we can see here slide 15. Okay, so see some examples. So slide 15. Okay, so slide 15 here, there is also discussion between owners. So that discussion happens later in the Melville. So the Melville reference will be later. Let me see where that reference is. Value of a supply. There's a discussion about now they've gone on to composite supplies and imports and exports. So I think this comes much later. It comes at maybe 490 or something like that. The tax point, let me see if I can see. Okay, the value added tax point, invoices, accounting references. Where is the Lennox method? Anyway, I can't find it right now. There is something called a Lennox method. This is essentially the Lennox method, what we are doing here. It's a double accounting. Or you can just do the net. In the exam, I think you should just do double accounting. That is better. It's because that's what they have suggested in the slides. So you just do double accounting. Claim the full input tax credit, but whatever is consumed by the business. So I'll give you another example for this. Slide 15. Okay. Private use of mobile phones, monthly service bill, okay, show as self-supply in out. Do you understand what I mean here? Private use of mobile phones, monthly service bills, if you get some information on that, same thing that will happen here, okay? Let's do this here as private use mobile bills. So the monthly bill is not for the instrument, the monthly bill is only for the service, right? So private use mobile bills, suppose you have some information that mobile bills, so the company pays the mobile bills, that's fine. The company pays the total mobile bill. Okay, so now this should not be this, should be blue. Maybe what blue is it? Yeah. So company pays the total mobile bill. So once again, understand this carefully here. When you have total mobile bill, we haven't come to the format yet, but I've shown you the total. So suppose the total mobile bill is 7,500. Okay. So total mobile bill is 7,500. Out of that, you are given some information that maybe 40% of this mobile bill is for private use. Now this cannot be allowed as an input tax credit. So what do you have to do? So let's say 40%. This is, let's say, maybe private use mobile bills. We can make this font a little smaller. And we can write the private use percentage as 0.4, okay? 40%. So we know that how much we have to value of supply, zero point 0.4 here. We have to take 0.4 times the total mobile bill. So total mobile bills for which you have claimed input tax is 7,500 value of the supply. But you know that out of that 40% is for private use of the mobile bill service. So that's not going to be allowed. So you have to charge it back to the employees and pay it to the government, right? So that one has to be 0.4 times 7,500. So let's say you pay 20% tax on this. So all this actually should be, this should be F29 right? Now we can just adjust everywhere, and we can write this here as oh, it is still 600. Never mind. Okay, we'll just change the color. Right, now you see what happens. So you have a subtotal here, okay, and so you have a subtotal here, let's say, maybe we do the subtotal here, which is 600 plus 60. This is to pay to government, pay to HMRC, and this is received from HMRC. So the receipt from HMRC, the net, let's say the subtotal is this plus this, so 1,700 to pay. So net pay is the net receipt from HMRC is only 1040. Is this clear? Are you following this here? So remember these adjustments, okay? For private use, for supplies, self-supply to owner, this is how it should be treated. All right, let's look at this, see how much time we have left. Anyway, it doesn't really matter. It will go off when it goes off. We have about 9 minutes, so let's see what happens. Okay, so yeah, okay, so this one we already discussed. Long-term contract, so we'll discuss this later on. But anytime you get any advance payment on a long-term contract, that we will discuss the tax point later. We won't have discussion of, we won't be able to discuss the tax point in this class. But this will be a tax point, okay? So if you have time, please study the tax point rules from the Melville book and also from the Open Tuition. You'll see some examples there. That's also a very important concept in VAT. But anyway, the bottom line is in VAT we go by a cash basis. So whenever you receive a payment for this kind of thing, we go by cash basis. So even if there's a long-term contract, maybe there's a long-term construction contract going on, you are building, you're providing a service maybe, or maybe you're providing some supplies, and from time to time you receive payment. So the moment you receive payment, you have to charge the output tax on it, okay? So supply a standard rate of VAT, okay? So anytime you get an advance payment, that means it is basically a supply has happened. So maybe even if you get an advance payment, or you get an intermediate payment, maybe the supply has not yet happened physically, but because you got the payment, it will get treated as a point of supply. It's a tax point for supply, a tax point where we say that the supply is deemed to have occurred. So immediately you have to include it in that period. Why is the timing so important? Because every quarter you need to file a VAT return. So if you need to keep track of whatever taxable supplies are happening in that quarter, because those taxable supplies have to be included in that quarter's VAT return. So this will go in the output VAT. This will go in the output VAT box, because output VAT is paid to HMRC. So in output VAT, if you receive any advance payment here, you got advance payment, whatever is the amount of the advance payment, on that you charge tax. and then you pay that to HMRC. Okay. Of course, the payment already includes the VAT. Okay. So when you get the advance payment, they will include typically the VAT included. So it will be a VAT inclusive price. So you'll get a VAT inclusive price somewhere here, and whatever that is, you apply 1/6, 1.1/6 if it's standard rated supply, and then so advance payment are treated as some standard rated supplies. So if you get any advance payment, so you should remember that it's treated as a standard rated supplies. Then you'll get a full advance payment of something, right? And so what is the VAT amount? Maybe you'll get a full advance payment of say 16,000, maybe 16,450. That is a full advance payment made by your customer. And so this obviously is the VAT inclusive price, because the customer has to always pay. When you invoice the customer, you already invoiced him for including the VAT. So that means if he paid, this is, let's say, the VAT inclusive price. No. So VIP here means VAT inclusive price. The VAT inclusive price is this. So what is this? This is basically the VAT amount will be this times 1/6. It's a standard rated. Advance payment is treated as standard rated supply. So that's your VAT amount. Okay, it's 1/6 of the 1/6 times the VAT inclusive price. That's your VAT amount. Okay. Yeah, that you can just round off to. Yeah, okay, so that's your long-term contract. We will deal with it again later on. There's a tax point discussion where the long-term contract, early payment or part payment under a long-term contract will again come into the picture when we discuss tax points. Own supplies. Now this I've already discussed, okay? This thing which you see here being mentioned, I have already discussed it with it. Here's the part about the private use of mobile phones. So I have already shown you how this happens, so we don't need to spend more time on this right now. But private use of mobile phones, you can see how it is shown in the output tax. You'll be typically given information that the mobile phone bill is so much, but 40% of that is for private use by employees. And remember, mobile phone bill is for the service, right? So trader supplies, own goods, all these examples I have shown you already here. Slide 15, slide 17. Okay, so you can say slide 15, slide 17. Yeah, slide 16 is a different thing. Own supply, slide 17. Then overseas aspects of VAT. Now, here I would recommend strongly that you don't follow the material in the slides and the material in the Melville textbook. It's very complicated. You follow my framework. If you try to follow that, you'll get confused. Okay, it's a very confusing and there are a lot of typos also actually. So for import exports, so there are only two types of import exports, right? There's only goods and supplies, goods and services. Okay, so you can see goods and services. Let's do something here. Goods and services. So for import export, maybe we can draw it here, right? Okay, so goods and services, import export. So we can do it twice. Maybe we can do it here. Okay, now how do we write this? Well, let's talk about let's talk about imports and exports. Okay, so maybe we talk about imports and exports. Okay, so for let's look at import and export. Okay, so of goods and services, and let's talk about this as equal to C40. All right, so first let's look at the goods side first. Goods, import, international trade in goods and services. What is the framework? That's what slide is 18 onwards. Okay, slide 18 onwards. All right, so now go back to my definition once again, that VAT is going to be charged. It's a tax on, what did I say here? Domestic, final, or intermediate consumption, okay? So when the goods are being imported and exported, we don't really care whether it's final or intermediate. It is some kind of consumption, right? Whoever's buying it is consuming the goods, is treated as consuming the goods. Now, remember domestic consumption. Now, we are dealing with UK VAT, right? So, if the rule is VAT is charged on a supply with, it's a domestic supply of goods and services, okay? Whenever there is any domestic consumption of goods and services. So, if I export chocolates from the UK to Germany, is that a domestic supply of goods? Is there domestic consumption of that? Yes or no? If I'm exporting goods, chocolates from UK to Germany, is there domestic consumption of those chocolates? No, because it's being consumed in Germany. Okay, so I'll spend just 1 minute to clarify the goods part of it. The services part will continue later. But so remember this rule. So it's only going to be, so to determine whether a certain export of a good or import of a good is taxable in the UK under VAT, you just have to think about, is this thing getting consumed in the UK? Okay, it could be intermediate, could be final, but is it getting consumed in the UK? UK company selling chocolates to Germany, those chocolates are not going to be consumed in the UK. So, no VAT. Do you understand? Zero VAT, zero rated VAT. But if a French winemaker is shipping wine to London, you're importing in London, you're importing wine from France, is that going to be consumed in the UK? Yes, right? So now you know you have to, that is chargeable to VAT, UK VAT, because that wine being brought in from France, that will be consumed in the UK, so it is chargeable to UK VAT. Now, who will collect the tax? Who will pay the tax? That's a separate question, okay? Just think about my framework here for goods, exports and imports. Just think about whether, is it chargeable to VAT? Just apply this framework. If it's going to be consumed in the UK, yes, it will be chargeable to VAT. If it's not consumed in the UK, it will not be chargeable, it will be zero rated, all right? Now, who will pay the tax? Who will collect the tax? That's a separate question. The reason I'm asking you to stay away from the Melville and the slides on this topic is because in Melville he has conflated the two items. Who is collecting the VAT and how it is paid to the government? He has conflated that with whether the VAT is chargeable or not. And it's very difficult for you to understand if you follow it from that method. Again, we stop it here. So I need to make a note here quickly first. I need to make a note here as to where we stopped. Okay. And so in your class, we have stopped a little bit later, a little bit earlier actually. In your class, we have stopped in week 10. Okay, so we're almost the same, but we are slightly different. In the previous class, we had gone to 24, but I couldn't finish that here. So 18, start of slide 18. Okay, long-term prepayment, okay, that's fine. I already mentioned it, but start of slide 18, and here we say that international trade in goods is done, okay? So then I know that the services is not done. Okay, fine, we'll continue in the next week. All right. So now we can go to our attendance. Now, before I go to attendance, now let me close this thing first. Let me stop the recording and close this.